Hey Arshit, hey Pranav, guys. How do you add a tweet on this? I know there are I've seen people adding tweets to their spaces. I just I just don't know how to do that. Anyways, so very random space here. Uh, nothing on agenda. Nothing planned. I'm just going to invite a few of you guys to be the speakers. Um, let couple of other people join in, otherwise we'll start in a minute or so. The idea is really, as the name suggests, just an open mic. uh, any sort of topics that come to mind that you think you can bounce off ideas with, or just have a interesting discussion with. I don't know if you guys can hear me. Can you kind of maybe comment, or what do you call it, do the smiley thing if you are if you can hear me. Hmm. Pranav, can you hear me? Can anybody else hear me?
I can hear
Oh
you.
yeah. Hey Pranav. So we
Hey,
have Vivek, Prashant, all the good folks. All right. So we have a full house, man. I mean, all the everybody and anybody who I can imagine to provide value to the space is here. So I've just sent out invites. If you can speak, just join in. If you can't, that's fine by me as well. All right, so let's get started यार. कोई there's no fixed agenda. I just thought मैं बैठा हुआ बोर हो रहा था आज, तो just thought let's do a space. Let's think. We all get a lot of questions in DMs on trading and whatnot. So just thought कि चलो स्पेस करते हैं, कुछ टॉपिक डिस्कस करते हैं. So the idea is, this is, the name, just as the name suggests, just an open mic. You can come on the stage, share your experience, or ask questions. This is not really a topic based thing wherein we have a preset topic in mind. So I'll just open it up for the whole audience right away from the start. Anybody who wants to take up any first question to ask, and then maybe we can start, the flow of discussion and thoughts can start from there. So really open to everybody who wants to uh, maybe ask a question, or come share your experience. Pranav,
hey,
if you want
Ankit.
to add anything. Hey.
Hey, good evening. I'm seeing Prashant here also. So between the two of you, I thought let's kick this off. Let's ask a question which I have asked you in the past before also, but why not? At what point of time should you be scared when you're doing your analysis, everything, that the sample size starts getting too small? That, like, suppose I do an analysis and I say I see 30 occurrences of an event happening on the Nifty over the last 10 years. In my opinion, that would be too small, but many people might trade it. So, what's your opinion on that?
Right. So great question, Pranav. By the way, I've sent invite to Prashant as well, and anybody else who wants to speak can send a mic request. But I'll just share my thoughts, and I would really appreciate it. Everybody else who also does that can share their thoughts as well. So I do that kind of pattern testing and analysis a lot. So what I mean by that is, there was this earlier last week we were discussing how there are some gaps, how they can be traded and faded. There could be, when once the market opens up with a gap, how do you, what can it do, right? So you can fade the gap, or you can trade a breakout. Those are the two sort of obvious ways out of it. And then a lot of people did analysis on that what happens the day after, once the market opens with a gap, how does it close? So that's a very rudimentary analysis, and starting it's a good starting point. But whomsoever who DM'd me about it, or who spoke to me, or at length about it, I told them it's a starting point. You can't trade a gap. You can't just say, okay, every time market opens by 2%, 3% gap, I'm going to either short it blindly or go long blindly. Like, every gap is different. So you can't just put a very blanket condition across the whole set of such occurrences. You have to condition it. So what do I mean by when I say you have to condition it? You have to condition it in the sense that you have to make more criteria to it. So, just for a very naive example is when market opens up with, let's say, 2%, but it's also opening up beyond previous day high or beyond previous week high, right? So that's additional condition. So that will limit your, the number of occurrences, but hopefully you'll get a uh, higher win rate or higher hit rate with that kind of analysis. Now, what would happen, and I think that's where Pranav's question comes in, is you keep on building conditions. Where do you know that you have curve fit? And B, if you have not curve fit, let's say you have built only such conditions which have occurred only twice or thrice in a year, or maybe twice or thrice in a quarter, or maybe 30 times in last 10 years or 5 years. How do you know whether it's tradable or not? So there are, one way I'd like to use it, and I know for sure Cora, who runs some program, also does this kind of analysis, is doing a t-test. So, what is a student's t-test? For those who don't know, in a very layman terms, I'll try to kind of quickly explain. You have a normal distribution of underlying returns. A log normal returns are log normally distributed, but nonetheless, for the sake of simplicity and a lot of analysis, people take normalization as a given. The difference between the two being normal distribution will not have as fat tails as you would see in log normal, or you will see in real markets as well. Nonetheless, so if you say that
Ankit, I
your
don't want to disturb you. I
pattern
want to
out,
ask everyone, is Ankit audible? Breaking up.
yeah, I mean,
Your voice is
can
breaking,
I
Ankit.
breaking up? I don't know if can the audience kind of
I don't know if it's just me. Can someone else confirm?
yeah, maybe subject to, can you wave or do the smiley or whatever? I don't it all comes somebody. Oh, I see Linda as well. Oh, I'm gonna invite. So all right, I'm gonna have. So by the way, guys, I have Linda here. So Linda is my. I went to Haas Berkeley. She was my program director there. And hey, Linda, happy to have you here. What a pleasant surprise.
Hi, can you hear me?
Yes,
Well,
yes,
I could
lovely to
hear
have you, Linda.
everything, by the way, so you didn't break up for me, so I don't know. Maybe it's a privilege that I have, but it's great to hear you. And I take it back, please.
All right, thank you. Thanks a lot, Linda. So, for everybody who's listening, and so Linda, by the way, I do get a lot of requests from people who want to pursue MFE, and I'm always like Berkeley. Berkeley is the place to be. No, nowhere else.
But
So
you know that I am now the crypto
I know.
blockchain track chair at Skydeck. So
Yes.
if anybody has a blockchain idea, want to be funded, we are an accelerator, and I invite everybody. You do not have to be a Berkeley student, as long as you're international, and you globally somewhere. So think about it, everyone, and back to you, Ankit, and thank you.
No, perfect. I'll probably we can do a quick pivot, Linda. Why don't you tell us? Even I'm interested. I read your tweet about the incubator. So why don't you introduce that to the audience? There's a lot of Indian traders and analysts who are working with us here. Maybe you
Right.
can introduce.
So Skydeck is an accelerator, and what we do is that we give you $200,000 and a place to stay, to have an office, for a few months. Obviously, in exchange for 7.5% equity, and we do that obviously because we want to fund as many startups as possible. Now, you do not need to be in blockchain and crypto. This is what I am developing for Berkeley, right? You can be in biotech, you can be in tech, anything, right? And please read, Skydeck at Berkeley. You'll see how many startups made it, owing to us. So applications actually are were from August 31st to, from July all the way to the end of August. And again, go to the website if you have any questions. write to me, or I'm on Twitter, and my email address, I can tell you, in fact, is lkreitzman at berkeley.edu, and it's LKREITZMAN. I am very fond of decentralized finance. I believe it's the future. And this is after being for more than 20 years in TradFi. And, I think we're going through kind of a tough time, but there's a lot of great technology that is being built. And, again, the future is DeFi. So I urge everybody to have an application. There are very smart people in here listening. I checked some of you, and not everybody. I haven't had time. So thank you again. And I love to help even students, alumni of other schools. So reach out to me. Thank you, Ankit. And now
Thank,
back to you.
thank you, Linda. So anybody who's listening this right now, or even in the future, I must tell something about Linda's and how Berkeley MFE is what it is because of efforts that she has put in over the last decade or more, right? So, she was one of the founding members of the MFE Berkeley program, and where it stands today is because of, the earnest efforts I've seen her do when we were in school and continues to do. Like, I'm an alumni. It's been a decade since I've graduated. Even today, she's so accessible to me that I know if I email her, I'll get a response within 24 hours. So anybody who's interested, if you're applying, you'll be going into a good hands. So by all means do that. Thank you, Linda, for your introduction. Happy and lovely to have you here.
Thank you so much.
So going back to our discussion around how do you know, so just quick recap on if you've found a pattern or analysis, you've done analysis, if you've found that it occurs only 30 times, 50 times in over the last 4 or 5 years, how do you know whether this will continue? How do you kind of gain confidence around it or to trade it with your live money, right? So that's where some of the statistical tools that I was talking about, like an example is the t-test, which is like when you compare the distribution of your returns out of this pattern. So let me try to break it down. So let's say you have a pattern of 2 green days followed by 1 red day, right? Just a very simplistic idea. And you do this and you find, okay, last 10 years, how many times it has occurred. You find it says only occurred 50 times and it gives you 20 basis point or 0.5% or whatever return it is. And then you have, each instance when it occurred, you have a return for it, right? So you have a time series or you have a series of returns for it, which essentially is nothing but a distribution in statistical sense, right? So what a t-test helps you do is it helps you compare your distribution with a normal distribution. It's called student's t-test for those who don't know, and kind of gives you a p-score, or it kind of gives you a probability of, in layman terms, it gives you an output which says how distinct is your distribution from a normal or random observation. Is this distribution an occurrence of a chance, or is it because of something underlying effect, right? So I don't want to derail this whole conversation into going into details of that, but that's one example. Now the other thing is, it's something qualitative in nature. I know, Pranav, you're still here. I know you're probably having some difficulties in listening in, but so if it's a daily chart based analysis and you find it's occurring once in a quarter, it's very hard to put money on it. So how would you do it? I would do it the way I would do it. What I would do is, and this was one of the other questions asked, is how do you trade ensembles? So you have one pattern which occurs 30 times. You can have 10 such patterns, taking your instance to 300 times. And now you create an ensemble. In a simplistic way, you just create an aggregation of all of that and see how many times the aggregate patterns can occur. Will it give you 300 instances? Will that, even if one single pattern is not giving you statistical significant results or not occurring, n number of enough times, on an ensemble basis, you might be able to get that kind of comfort both statistically and the number of count wise, right? So that's one way out of it. Otherwise, unfortunately, if it's that small numbers, I would not never ever trade a pattern like that in isolation. It has to be a part of a portfolio, or it can also feed into another set of analysis. So I'll give you an example. So you've done this analysis on, this is called delta moves in options parlance, right? In options world, this is, when X moves by 2%, what does Y move by? Can you do that analysis with an overlayer of VIX or IVs on that, right? I know VIX is 1 month forward variance and IV is the, whatever, up to the next expiry or an annualized. There are different metrics. But you can also do this, okay, if this pattern is more reliable during the VIX analysis or during a particular VIX regime or not, and maybe you can then bring in more categories of more patterns into the whole spectrum. So, I mean, to try and answer your long question in a succinct way, the idea is you do some statistical testing. T-test, students t-test is one of the simplest one to do, and B, try to find an ensemble of such patterns which will give you more reliable outcomes in a portfolio. And again, the stage is open. It's not me. Anybody can come in and maybe share your thoughts if you have done something or ask a question. Anything, Prathamesh, do you think anything to add from your side on this? I don't think so.
No,
Oh,
I
yeah.
think that's a good idea. I would say that even before you get to the point where you run statistical tests, I think you want to have a clear idea of what it is that you're testing. So, like in the gaps trade, do you have some kind of rationale for why the price behaves in a particular way? Like it might be that many of those gaps happen at the end of the month or like in the expiry week when positions are being rolled over or so on. You need not get your answer exactly right, but you should at least have some idea of what might be happening. And I think that's a better way to filter down just spurious patterns, because otherwise the kind of universe of patterns that you can potentially test is just infinite, and you don't want to just find something that lasts for maybe a month or a few days and it just stops working after.
And that's, also the concern with data mining, right? The curve fitting also kind of comes in it. Like Prathamesh said, if you test 20,000 patterns in a, data miner code, you'll find something. But is it spurious or does it have any rationale to it? So very well, like, if you're testing a pattern, if you're observing something, think about what kind of market behavior does it exhibit? Is it just you're randomly picking some rules which are curve fitting over the period you're testing, or does it have some form of support or analysis on that, right? So Pranav is still here, but I'm gonna move on to the next. I don't who's this sugar market news? Sugar alerts. I don't know. Do you have a question or thought to share? Otherwise, Prakash Srinivasan can also speak if they want.
Hi, Ankit. I don't have anything. I'm just listening to it.
Okay.
Yeah, thanks for the opportunity. Yeah, please go ahead, Ankit.
I mean, honestly, this is really, I mean, I didn't really have a lot of topics in mind to discuss. I would highly encourage people to come up and maybe ask a question or suggest a topic if you want to, or maybe tweet to me if you can't speak. Uh, I really don't
Ankit,
want
I have
people
a
to
topic.
Yeah, sure, please.
So, a lot of times if you're trading a position that is some kind of intraday pattern, then you can use options instead of futures. So when is it a better idea to use a deep in the money option versus an at the money option at say 2x the quantity? Any thoughts on this?
Oh man, I wish I had the expert who can actually comment on this can speak. Prashant Bhai is here. I am actually so novice. I consider myself to be a novice. So, but thinking out loud, I've kind of pondered over it at times. I don't have an answer, so take my response with a pinch of salt. Uh, but what I ended up doing, I'll share what I ended up doing with a couple of systems that I trade. Okay, so if I'm first thing to think about is what is it I'm trading? Like I'm trading intraday momentum, intraday mean reversion, intraday X, Y, Z. What am I trying to trade with this, this system? That's the first thing to consider. So if you are trading intraday momentum, you probably somebody can, and you're doing this by, let's say, going long on options and assuming the wall is constant and you're not, you've hedged it out or whatever, like, not going into the technicalities of it, just thinking about from a delta move perspective, you can probably think about trading an ITM or deep ITM in the option. And I know a couple of traders on Twitter do that for intraday momentum based options trading. And the idea is very simple there, thinking about a slightly deep ITM in the option. Your delta is, let's say, 75 delta or 80 delta option, if not it's one, or maybe 60 delta option. You are expected to get a similar exposure as a standalone future, but then your capital requirement is less, so you can better manage your exposure and risk. And let's say if something completely goes off, you kind of have an inherent stop loss because of the downside convexity slash concavity, I don't know the right term, because the options, if it declines, if it goes against you, there's this linear portion in between, like, of an option price, wherein it will be linearly related with the price, with the underlying price. But then in deep ITM or deep OTM, it's gonna plateau both ways. So you can, even if it falls, as the market, let's say market starts going against you, your delta of the option will decrease. So in a way, if market drops the first 100 points, you'll probably lose close to 100 or 75. But let's say the next subsequent every 100 points, the amount of money you will lose on that exposure will be less than that trading an outright future, right? So you kind of putting the brakes on as it goes against you. And it's on the other side, let's say you started with 70 delta or 75 delta ITM. If it goes in your favor, then it's going to quickly hit 1 delta, so you're going to be able to match up to that. So there's a lot of nuance to it. If somebody believes their momentum signal has strength, you can do some form of ITM analysis. But I would say, Prathamesh, you would know it, right? Anyways, that ATM will be not much different. It's just that with an ITM, you can with a combination of ATM and ITM, you can, let's say, if you have a large portfolio and you take delta of exposure, you can be doing a mix and match rather than doing 5 lot futures, right? So that's how I would think about it. And this is again discounting off anything to do with IV and volatility. I'm assuming this is pure intraday gig, right? And then the one thing that I do for quick signals, for example, so that's a system which I run and which has 1 day holding period. It starts today, it ends tomorrow. It just, and it has actually, it has been developed through this, some of the patterns that I was talking about earlier. And in that, I made an assumption that, okay, if I go long today, let's say long as in the market going long, your long calls, and you're exiting tomorrow, over the sufficiently long time, the wall benefit and drag on it, like, at times I'm right about the delta move, but the wall drops. So I bought the option today, but tomorrow when the market opens and trading, the wall drops, even though it market moved in my direction, but the wall dropped. I did not make enough money, whereas my underlying would have. And the other way also happens, right? That I did buy it, I did not get delta move, but then I got the wall jump at times, right? So it can go both ways. So I've done a bit of analysis, and what I saw was the effect of wall kind of cancelled out over a longer period of time. Over short period, it could be seen that sometimes it hurts you, sometimes it doesn't. But then over the longer period of time, kind of cancelled out, given the fact that I was only holding it for 1 day. So right, so that also has to be taken into account. What's your holding period? What's the underlying effect you're trying to harvest? And how do you go about trading it? I see Prashant joining on the stage. Hey, Prashant, do you want to add something to that?
Hey, Ankit. No, I think that was a great answer. Just a very quick thing I'll add is you want to choose your option based on what risk you want exposure to. One thing that I talk with a lot of my people I work with in options is that uh, the option chain is a continuum, and you choose your option strike. If you are selecting a strike, you choose it based on what risk you want exposure to. So if you're trading direction and you don't want any other risks on your book, because as you guys know, options come with not only directional risk but all other risks as well. So if you don't want any other risks on the book, then it's obviously better to go as deep ITM as you can, as much as the liquidity will allow you for your size that you're trading. I mean, if you're trying to buy like 1,000 lots and you want to go really deep ITM, then you got to be careful whether you're only even going to get the fills that you're trying to get, right? So that's one thing. If you understand that if you're going ATM or slightly OTM, you are taking on other risks, and so if you don't want those risks on your book, which are time and volatility, then you're better off just going direction with deeper in the money options.
Lovely, thanks. Let's have the next speaker. Is it Prakash or Jitendra? I know these guys have been on before others. Prakash, did you speak already? I'm sorry.
Yeah, I spoke already, Ankit. Like I am just listening to it. I'm just your
Okay.
follower.
So
Okay.
I'm just gonna remove you from the speaker panel. Otherwise, I get confused.
Yeah, please, please. Yeah.
All right. So Jitendra, do you have a question or thought? No. Okay. I'm just gonna.
If Jitendra doesn't have a question, I have a question. It was a very interesting
Yeah, sure.
piece tweet I just read. Karan, who's in the audience, it was his tweet. He asked, there's a situation he went through, and he asked whether he committed a sin or not. And I'll try and describe the situation as best I understood. So he's got a systematic method to stay invested or exit equities. And let's say it's not him. Let's say it's somebody else, right? But and when Nifty was somewhere at its lows a month ago, the system indicated him to get out of equities, and for whatever reason he wasn't able to. And say he woke up yesterday and found that Nifty is breaking all-time highs or getting closer to its all-time high. So has he committed a sin? And if so, then what should he do? Your guys' thoughts?
Oh man. So if I understand correctly, the system kind of at the lows asked you to get out, get flat. You couldn't or didn't, and now you see markets going again to the high. So kind of it worked out for you, but have you committed inherent sin in systematic? Right. That's right, Prashant. That's if I understood that.
Yeah, I guess that's the question.
See, I'll share my thought. I don't know. I don't think there's a very definite answer to it. Um, Maybe it's it's how you perceive it. If you perceive it as a just a second, guys. I'll have to be mute for a second, please. Yeah.
And Karan, if you want to come up on stage and put your thoughts out as well, you're welcome.
Yeah, I'm gonna invite him anyways. So I would say, for your PNL's perspective, it's not a sin, right? You saved up a lot of what do you call it? Just a second, who's this? Yeah, you saved up capital, but ideally, see, on the recent times, I started with a lot of systematic trading and thoughts in mind. Key, everything has to be very, very systematic and very, very nothing, no deviation from it. But then over the last quarter, these 2 quarters, what has taught me is there were times, realizing what's going on in the market, looking at the IV levels or VIX levels. That's very well at least known. I kind of knew that my momentum trading is negatively correlated with VIX. So if it goes high because of, think about VIX and IVs going high means there's a lot of volatility and momentum gets killed by volatility. It's just not work, right? But I did not override my system. And then the reason for me to be apprehensive about it was I wanted to have a systematic way of defining or quantifying that rule before I would put it on. But I kind of I was feeling it in my gut that this is the reason, and it was not like it was coming out of thin air. It was just very well rational reason. So what I believe is some of the discretionary traders I've met in this journey, they sometimes may not be able to quantify a lot of things, but they're able to pull up some very realistic and very nice outputs, right? So if you think about that, even if you're a systematic trader, but you've been in the markets, I know Karan has been around for a while. So if you've been around for that long, you've seen different cycles, you kind of at times get to that level wherein you can override that system, though it's not really overriding, it's really well thought of, researched, and maybe calculated output which can help you override. So I don't have a definite answer to it. I see Vivek is well on the audience. I'll see if he has something to add, or even Prathamesh or Prashant yourself. You ask the question though, it will be interesting to hear your thoughts.
So over time, what I've seen is if you have rules that you've tested and they work well in the past, then it's more likely that at some point it may be that the system gives a real exit, and the because you don't take the signal the next time because it failed the last time. This time it does work, and you end up exiting much lower. So you might have just delayed or like postponed the drawdown from one trade to another. And the other possibility is that you maybe found some way to improve your system by figuring out, kind of eliminating adding some extra filters that would eliminate this kind of signal. So I think either way, it's a opportunity to like learn something new.
Hey Vivek, anything on that?
Hey guys, so I've been thinking a lot about this actually lately, and so trend following, in my opinion, is essentially like a risk mitigation strategy, right? Where you are preventing a major crash by getting out. But the downside of it is like if the market recovers really quickly after your signal, you feel really, really bad, and then it's more difficult to get in after the rally. So it's a really tough problem to solve from a trend following perspective, because in fact, when the market's low, unless you get a 2008, like you should be buying aggressively rather than selling at that point, right? So it's kind of like a problem that's difficult to solve because you're trying to prevent suffering through a major crash, and also at the same time you're trying to prevent like regret. So I think maybe like a better way is to be not so binary about it and look at it more as a dial than as a on off switch. That's one approach, and maybe the other way is, and then maybe Prashant can add to that, is like maybe have overlay hedges instead of getting in and out. But yeah, so I'm experimenting more with like sort of using it as a dial and maybe raising a bit of cash and then redeploying, do kind of like wall targeting or something similar, rather than treating it as an on-off switch, because it's really hard emotionally to execute that.
Yeah, so Vivek, even with the dialing kind of a system, let's say dials are not continuous, right? They're discrete. Yes, you have minimized the step size, but it's still discrete. So at every discrete step, it's the same decision, right? That at point, like, yeah, I understand that rather than going zero and off, but I think the essence of the question was, do we skip them at all? Because what you are saying is you implement a more continual kind of an exposure signal, and that way you are scaling up and scaling down as the market or whatever things change, which is like, then you're like, we are sticking to the system, our system is taking care of these, kind of minimizing the randomness in a signal, right? uh, so yeah, that's an interesting point as well. I don't know, Prashant, if you have anything to add, otherwise we'll get another audience question.
No, I don't really have anything to add. I just wanted your views on it. But I like the point that Vivek brought up, that exits in trend following systems are essentially targeted towards minimizing further risk and further minimizing drawdowns. And by not taking a signal, if you've already accepted and gone through that drawdown, then I guess you don't need to be too hard on yourself, right? So
True. Interesting. Let's go to, I know Jiten, we gave him a first chance. I know, Jiten, can you speak now? If not, we'll go to Sugavanesh. Okay.
Yeah, hi Ankit.
Let's get. Hey.
Ankit, I have like a couple of questions. Maybe like first question like it would be great if you could like an algorithmic for the quantitative based.
I'm sorry.
So for
Your
example,
voice broke up. I couldn't understand your first sentence. Could you
so
repeat
if
that, please?
yeah, if you could tell me the difference between the algorithmic trading and quantitative trading.
Oh, so what's the difference? So I think this there's a lot of overlap on the two terms, right? Algorithms is kind of
So
logical building blocks. Sure. So you want to add something?
yeah, just 1 second. Let's say like I have a EMA cross system, like crossover system, for example, simple EMA crossover. So I consider this as an algorithmic. So how can be this analyzed with some kind of like quantitative knowledge on this?
Right. So so algorithms is nothing but set of rules. Logical rules put together is an algorithm. So a quantitative analysis will need an algorithm in some form or fashion, right? But usually a quantitative analysis is something which is, let's say, statistically driven. So earlier in this space, we were talking about using a test to see if the patterns, the distribution of your returns from specific patterns make statistical sense or not. That's a quantitative example. So, there is no, I wouldn't, I would say it's not like very distinct two terms like algo and quant systems are completely different. I would say on the quantitative side, it's more about analysis that you do, which can lead to some rules or methods that you would go about trading. So, in my opinion, quantitative analysis comes before you will go or, go out and create some logical rules to trade about it. Like this, the gap analysis that we've been talking about on Twitter for some last week, that's just you observe something, you take that, you crunch data into it, you look at the patterns, and you see if it's statistically making sense or not. That's the kind of quantitative analysis. Or if you're doing some options trading and you don't believe that theta is the edge, you actually want to build out a wall surface or a wall model to kind of predict the walls, or whatever you want to do, that's all quantitative analysis. You build your models through that phase and then come to trading. So in your example, EMA crossover is, let's say, quant analysis 001, like the very first step, right? But then it's a whole field backing that. And I don't know if anybody else wants to add to that thought. But that's how I think about it. I think Sugavanesh actually dropped off. Um, all right, let's get to the next speaker then. Garvit.
Hi, Ankit.
Hey.
Okay, so I have a kind of a non question related to not to trading. Is that okay?
Sure. I mean, this is hopefully a trading space, but then if anything, I mean, I'm not sure if we are fit for life coaches, but we'll try. Why don't you start?
Okay. So the thing is, we are working 10 hours, 12 hours a day in the front of a screen, right? I have an IT job, plus I do trading as well. Uh, do you guys at any point think why am I sitting in front of a screen all day? Like at the end of the day, I just want to shut the laptop and get out. It kind of exhausts me. I like my job and training as well, but it is kind of lonely and you know, it's not very meaningful, I would say. It's productive, but any
So
thoughts?
what's the question? So okay, this is how you feel, but I mean,
Like,
what do you want to
the,
ask?
does the same happen with you guys, or how do you deal with it at the end of the day? Do
Um,
you get exhausted or from it, or
Yeah, I would say anybody would get exhausted with a screen. I think all of us spend time offline. I know Prashant goes and plays cricket. He takes his son to represent India in chess games. I know. I mean, I do. I go for swim. I mean, I'm sure Everybody takes time off the screen to, kind of settle them and regenerate themselves. I think that's a very standard thing to do. And I'm sure. Um, I mean, if you spend too long on the screen, it's going to tire you out and would want you should take a break. It's just good body / health hygiene, so to say, right? Yeah, I don't think I have anything else to add on that. It's something that would expect people to do anyways. Um, I'll have Muthu Kishore speak next.
Hi Ankit, good evening.
Hey.
Hey, how are you? Am I audible?
Yeah, please.
Okay. Hi Prashant ji, how are you? Long time.
Hey, Pranav, yes, but can somebody else is asking questions for now?
Yeah, no, I just wanted to add into that point that was being made. Sorry,
Pranav, there's a lot of echo on your side.
uh,
We could hear you twice.
can you hear me now? I think someone else left the mic on.
Yes.
Ah.
Yeah, now we can.
So I was just reading about this in Augustin LeBron's book, and I would recommend that book to anyone who is facing questions like this. And in fact, his first chapter goes into the whole thing is you have to understand why you are trading. Are you doing it for the money? Are you doing it for the gambling thrill? Are you doing it for some other reason? Maybe something like that could actually help you in deciding future courses of actions. And if you are feeling burnt out over things like this, maybe look at things like that. I completely recommend that book in this situation. I just want to put my 2 cents on this one.
No, definitely his book is quite pretty good. Laws of Trading. Actually, I shared a tweet this morning. He happened to be on a podcast yesterday. I shared that podcast tweet as well. So, yeah, I mean, lovely thought. Thanks. Sorry, Muthu, please continue your thought, please.
Ankit?
Yes, please.
Yeah, okay. First of all, thanks for this space, and it was good listening to you. Meanwhile, I had one thing that I heard a new word. So I just want to ask you what is meant by that and how to use that. That is, you guys were speaking about dial-in during that trend following system. Whether there was a question whether he didn't exit, but there was whether it was right or not. So there was a word that was mentioned called dial or hard stop, something like that. So just want to know what is that in algo trading or this quant.
Yeah, sure. So, maybe, and Muthu, can you mute yourself? Because I think we hear echo when you speak. Okay. So I'll maybe Vivek can take that up. I know he brought that topic up, so he.
Sure. I think the discussion was around trend falling on the index. So that's very different from trend falling on individual stocks or other instruments or futures, for example, on individual stocks or options. So if you're looking at your exposure to the market, you can say that you're 100% invested in, say, for example, the index, like Nifty index, and you get a signal to exit. So then you're going from 100% to 0%. And as the market goes lower, obviously, you want to reduce your risk, because the risk of a major crash only happens after the market has already gone down, started going down, or the volatility has picked up. So essentially, you're trying to reduce your exposure to the market by reducing down from 100%, whatever number that is comfortable for you, even up to 0%. But you do it in a gradual, stepwise fashion versus going to zero. And then, the risk is that the market actually bottoms there and goes up from there. So while it's just one trade, but, if you're trend falling on the index, you'll take multiple trades for you to sort of come up from. There can be a lot of whipsaws, and it can take months or years for you to recover those losses. So even though the loss is notional, but it may take. So emotionally, it can be more challenging to sort of do that, especially if you're trend falling only on one particular index versus like a basket of underlying, which could be stocks, commodities, currencies, etc. So that's why I was saying that maybe it's better to use it as a dial, reduce your exposure as the volatility is going up and market is going down, and then increase your exposure back when market seems to be settling down, momentum is coming back, volatility is reducing. I hope that answers your question.
Okay, I think you mean to say that when the market goes down, instead of in a trend following system and index, instead of just quitting completely and feeling bad when the market goes up and not having a position, you can gradually reduce a position and still have some kind of position in the market, and add more positions as the market goes up. So this is what you're gradually reducing position, you're gradually adding the position, and you're taking by meeting that dial in means you mean that based on the market situation you are changing this quantities or position size. So instead of going hard on 100 to 0, 0 to 100, you're telling to go gradually reducing, gradually increasing. That's what you're meaning by dialing, right? Did I get it right? Vivek ji?
That's right.
Hello?
Yeah, that's right.
Yeah. Okay. Thank you so much. That's very useful.
Thanks, Putman. I'd just like to add just a simple example of this, right? So how do you, if you think about how do I decide on these parameters? So a very, very simple example is think about why would it work and in what situation. So the moving average crossover that somebody gave, right? So let's say instead of having one set of moving averages, you have 10 sets. Now, if you have 10 sets, then you know when the market is really bullish, you expect all of them to be in the right crossover state, right? So you expect it to be fully long, or if it's going up, and then if it's going down, you expect all of them to be fully short. So that's where you are fully, in your full maximum position size. And in the between, when market is, let's say, zigzagging, you would expect some of them to be long, some of them to be short. So I can either you can scale it up and down. So let's say only 5 are long, so I'll only be half of the value long or short. Or you can use a canceling mechanism as well, wherein you say, okay, I will only go long if if there's a net long, right? Because two moving averages are long and three are short. So essentially you have -1 left over. So I will only go -1 instead of saying I'll go 3 in one direction, because it's 3 out of 10 in one direction, right? So there are many ways you can use this scaling in or dialing in concept. And especially in trend following, it's been my experience, and I think Vivek is kind of supporting that. It helps you improve your returns, but it's much harder to do because instead of trading a single in and out, at times you have your half out, half in. So you're trading much more. So it comes with its own set of caveats, but yeah, that's what I have to add that. So thanks both of you.
So Ankit, there's a beautiful instrument that helps you do this, and it's one of the simplest instruments, right? It's the long dated long put. If say you're long Nifties and you buy, one of those June or December long puts at the money, you're going to essentially exit half your position, if you're one lot long. And as the market keeps falling, you're slowly exiting more and more of your position as that put is going in the money. You start with, if you have one lot, I'll give you an example of one lot, right? So if you're one lot long futures, or if you're long, say 8.5 lakhs of Nifty Bs, and you buy one long dated put, essentially you become long 4.5 lakhs or 4,25,000 worth of Nifty, right, at that point. And as the market falls, now you are long smaller and smaller quantities because that put is going more in the money. And that's just a very simple instrument that help you do this. If you're thinking about, how will I exit small quantities as the market keeps falling.
Very interesting. Thanks. Let's go to the next speaker, Algo Sniper.
Yeah. Hey guys. So yeah, my question is, what are the precautions you guys take in your algos so that you handle unexpected market situation? Consider the broker goes down, there's some bug in your algo, and you fire multiple orders. So I just want to give you an intro on what I do. So I personally, put a max loss for the day, some max loss set, system shutdown, everything is done. You can limit the max number of orders. So consider the number of orders crossed X. So then you get a message, you have crossed the max orders, no new orders will be placed. So I would like to, want to know what other precautions you guys take in your algo to prevent these kind of stuff.
So if I get to, so this is more of an execution question, right? So the question is, uh, how do you mitigate the risk of all these external factors? Is
Yeah.
that correct? Like broker going down?
Yeah, broker going down, some bug in your code, and it starts multiple order firing, those kind of stuff.
So see, some of those things are expected to be managed within the algo. Multiple order firing is nothing but a bug in your code. I mean, I would say it this way, until unless, there should be sort of forms and checks in your at your end to make sure that it's not, you're not firing multiple orders. Uh, but brokers going down, NSE feed going down, these are some of the very valid failure points. And unfortunately, there is not everything cannot be what do you call it, mitigated through code. So I am sure everybody manages their books. Can you mute yourself? Thank you. There was a lot of echo coming at the back. Uh, so I think that's why they say the algo trading cannot be unsupervised trading. Yes, at least at some form or some end, there should be some monitoring for some catastrophic kind of risks, right? Uh, an algo or an execution engine can take you so far, maybe 90-95% out there, but then there is always that tail event which can, like last year it happened, NSE shut down during the day, and then it opened at a very odd hour and then continued trading till I think 5:30 or 6 o'clock, whatever, right? So that was something new. Nobody could have planned for it. So it was really the unknown that you can never mitigate. Then there's a concept of known unknown. So something unknown might come in, and that's you can mitigate some of that. So example of monitoring is that thing that you don't know what may go wrong, but some of these are potential things that go wrong, from data feeds to brokers to your own server. You might be on AWS, DigitalOcean, or wherever you are, and they can go down, right? So these are some kind of known unknowns, I would say, which can be mitigated. And rest, I would say that you should be, that should be taken care of in your system. I don't know. Um Prashant, you guys do a lot of automation, right? So please chime in. I don't.
I would just add that I think it was a beautiful answer you gave. I just add that you just have to, block out every step of your own series of systems. What are all the failure points? Uh, in At GE, we used to call this doing an FMEA, right? Failure modes and effect analysis. So just go through each and every step that the data touches and see what all can fail, and it just depends on how you built your own system, and how you can figure out how to build some redundancies in there. Whether it means having multiple data sources, whether it means uh, looking at an AWS installation instead of doing it on your own on your own PC, eliminating things like your internet and power situation and so on. So it's just very individual, right? How you built each component of what you're doing.
Yeah, thanks, Prashant. Just wanted to know, any other specific risk aversion tools that you precautions you took. So as per me, even everything is on AWS, and I'm using, one of the most stable brokers out there. But just wanted to know other risk parameters which are unknown, like Ankit mentioned, unknowns. So any other specific risk checks you take, which are, which someone might not have thought of?
Oh, hi. Steve.
If it's strategy related, then we go through a phase of testing before we get to production on strategy. So think of it in terms of trials, and we run it for a while, run that code for a while on single lots, and then if see, because you don't know, like you mentioned, unknowns. You don't know what can go wrong, and you only have to just go through dry runs of it, uh, trial runs of it, and then go through a scaling procedure. So before you get to a I would say that you just, to test the code, you just have to go through that process.
Yeah.
This
Thanks for the response, guys. So one more thing I would like to add. So what I've personally done is you can catch out any error or any unexpected events you can using try except statements, and if it's a serious one, you could using some APIs send a phone to your mobile number, send a message or a phone call. That would also help you handle those unknowns. Yeah, that's it from me for the answers.
Thanks. Thank you. I know Pranav had a question.
Should I go?
Yeah, Pranav, please.
Hi. So this is going back to the original topic of this thing, which is quant trading, sort of. How do I phrase this? So recently I was trying to do some analysis on SIPs and the Nifty PE. And when I realized that post 2014, the PE has always been over 20, almost uniformly. So that got me thinking that at what point of time do you notice these big macro changes? Another example would be the introduction of weekly options in 2016, if I remember right. So this is an obvious big change. I don't want to call it macro change, or some systematic change that has happened. And how do you account for that versus doing a quantitative analysis on data that might precede that, sort of? Thanks.
Man, I'm not the best person to answer that on macro. I know, Vivek, you might actually have some thoughts on that.
So I have a couple of thoughts. So one is that I think like it's really important to understand the underlying factors that drive equity prices. So whether it's P or it's something else, etc. So it's very hard to do this on a quantitative basis, in my opinion. I think it's largely like understanding of markets and how they behave in different circumstances, and really getting down to the root of how markets work and why they go up and why they go down, really. So that just requires like a lot of, I guess, like a lot of observation and analysis on the macro, and also on the drivers of asset classes. And to be honest, like I'm not a big fan of PE because, as you said, there has been a change, and if something is not the right answer, then I would look at like what is the right answer. And so I mean that's my thought.
Thanks. No, I was speaking a little more broader than that. That's why I gave my second example, which is the introduction of weekly options in 2016. Now, obviously, they would have some effect on the market. So suppose you were going to do some analysis on Thursdays, on how the price action works on Thursdays. Does it make any point to even look on it in the pre-2016 data, for example?
So one thing I don't know the answer honestly, but just one thought on that question. This morning when I was listening to Augustine's podcast, he said something. Markets are very cyclical. A lot of effects they come up in a couple of decades later in any form, right? So I would never say that don't look at it. Maybe you can discount it off if need be, if you feel things have changed drastically, or so-called the regime has shifted. But personally, I would never throw it out. Just knowing that data point at the back of your head when you're doing all this analysis might help you. And sorry, Vivek, I think you were trying to add something on that.
No, I was just gonna say that I understood your question, but I think like it's more to do with like understanding, like even with options, like understanding what might change, and then how to incorporate data around that. So like someone who's a deep expert in options, like Prashant, may be able to understand what exactly would the effects be on market structure with the introduction of weekly options, for example, and then does it make sense to include data before that, and how to sort of use that data in a fashion that makes sense today. So I think it just comes down to like deeper understanding of how things might change and whether that makes sense logically, and then also like seeing whether your logic holds true going forward, right? So is your understanding correct of how that should impact the market structure?
All right, thanks.
I think it's a great question. I was actually, before you in your second part of your question talked about weeklies, I was just about to say that instead of looking at more macro information out there, just the market tradable information, which is the market structure of being able to trade weeklies or monthlies or introduction of monthlies or margin changes and things like that. Can have effects on how, at least if you're trading options, how they behave. I don't know if it translates back into how the underlying behaves, and that's a whole different ball game, right? Whether options affect how the underlying behaves, and I mean that can be debated for on and on. But back to that point of how, for example, introduction of weeklies might affect how options behave, you can definitely see that at least whether what the reason or whatever it is, you can definitely see that the liquidity and volumes on the monthly contracts has had an effect, right, after the introduction of the weeklies, whether it is Nifty or it is Bank Nifty across the board. The volumes shifted towards the weeklies. So the monthlies don't trade as much. They don't build as much open interest. They become the weekly option. So you can see that. Everybody can see that. That's happening. Now, how does the option pricing behavior change? That's a lot more nuanced, right? How that has evolved over time, because there are so many other factors. There is the underlying, the actual behavior of the underlying. How volatile is the Nifty today versus what it was in 2016? How volatile was it before, say in 2014, 15, or the Bank Nifty, for example? How volatile was it in the past versus what it is today? So those questions will probably have more of a bearing on how the option pricing themselves behave. So I think there's a lot going on in there which will have effects. Things like margin changes. Margin changes are a big change, right? It's a real structural change to how options are traded by everybody. Today you would see that there is practically very few people who would just trade naked straddles. There is no incentive not to buy those far out wings. So what happens? You see wings that are trading 2, 3, 4, 5 rupees, and on Friday, and they still trade 2 rupees on a Tuesday. So there's that effect of the artificial bumping up of the volatility very far out, IVs very far out, because they're just being held by everybody for margin benefit, right? So that's a structural change in the market. And so I guess you have to be cognizant of what's happening, and just take that and understand that the data interpretations have to be accounted for when you have these changes.
Thanks, Prashant.
Lovely, Prashant. Okay, let's go to sugar market news. This is the second attempt to get you.
No, the
All right,
first.
we can hear you.
Thanks for arranging the discussion. The first time was one of your colleagues mentioned if the sound is clear, give us a wave. So that's why I was waving the first time. But anyway, can you hear me now?
Yes, loud and clear.
Excellent. Basically, quant trading isn't necessarily high frequency, but sometimes a decent latency does matter when executing. So I just wanted to get your experiences, and perhaps your colleagues as well, I'll divide the question up. Let's say on the tools, and this can be pre-execution and execution. and for executing, with specific reference to speed and with specific reference to Python, R, and MATLAB. Now, some of them are good for using before you're trading, and some of them are a bit too slow, that maybe the programming language isn't optimal. So that's the first part. Shall I go on to the next part, or shall I let you answer that and then ask the next part?
Yeah, let's try and address that first, and then you
Okay.
can follow up, right? So let me open that up.
So basically, with specific reference to R, MATLAB, and Python, obviously, if you guys are using anything that you find gives you an advantage without spending the millions the banks spend on latency, then sharing that would be great.
Right. So let's, and if you don't mind just muting yourself, because otherwise I hear my echo.
Yes, we'll do.
Thank you. So, let's try and answer that from from a institutional versus individual perspective, right? That's where the question is. So you're right, and everybody would know it. All the high frequency trading firms, which are very super sensitive to latency, they are coding in much low level languages. Let's say C, or nowadays C, C++, Java. Nowadays Rust is something which is coming up, because their alpha is so latency sensitive. I mean, so much so that for some of the exchanges, they are not only co-located, they're using FPGAs to completely optimize that nanosecond as well. So that's what they are doing, and honestly, it's a function of the alpha of the system you're trying to trade, or the effect you're trying to trade. If your trading system, or if your effect is slowly converging one, or something which materializes over a span of a few minutes to a few hours, you don't need that latency sensitive infrastructure either. And I think that's where a lot of us come in. Like, we are, even though some of us have access to a colo server, or can directly punch orders into a co-located server, or have much more sophisticated softwares as well to create trade sophisticated or complex derivative structures in one go. But majority of us are trading through broker APIs. So wherein latency is, there's a bit of latency. It's not as high as somebody who's trying to trade manually, and it's not as low as somebody who's doing high frequency trading. So in our use case, I have at least found Python works perfectly fine. The reason I personally prefer Python is because you can use production code as well as research code. I'm not sure if MATLAB can do a live execution code. You can build a execution code on MATLAB. And for the analysis bit, I think R and Python are very similar. Some people who are very proficient in R, they swear by it. Some people who are good at Python swear by it. I'm not an expert on both. Rather, I'm not an expert on either to kind of compare. I would have anybody else to comment on that.
So
I'm not sure if that's the question.
You sort of addressed it, but let me rephrase it just a little bit, so maybe the answer is better targeted. Basically, at what level would you say, what sort of trading or frequency or whatever, or time frame does Python start to let you down? And if one was using Python, perhaps consider an alternative, and what would that alternative be? So this is the first part of the question. I'll back to you.
Right. So I'll say, what we do is, let's say if I time my Python code, let's say I created whatever the strategy is, and I'm timing it to see how soon it calculates the signal after the market data tick has arrived, and how soon can it send the order to the exchange. That's really all my latency is, right? And it's really in sub-seconds. It's not even 1 second, right? So I'm not trading anything which will require me to be ahead of others within that next second. So much so, actually, in some of our trading, we kind of try and wait as well if we think we can get a better fill. Sometimes we aggress the market as well, depending on where it is. So personally, I would say, and I know Prashant actually mentioned once, he trades some complex derivative structures in which he has to ensure all the legs of simultaneously in, right? So I think that's where they actually might have a vendor to help them out. But that's where I think Python may be a little laggy. And see, it also depends how not only your infrastructure, but also the broker's infrastructure. How latency sensitive are they? If you are, at the end of the day, you have an exchange and then you have a broker as a retailer, right? We have this two bridges to cross where an order can even reach the exchange, or even a market maker can take it. So, it really, really depends on your alpha. Not, I mean, let's say, I don't know how you are trading, but let's say if you're trading, if you're back testing on something which is not looking at the depth of the market, or L1, L2 data, or tick data, you may be creating candles of 1 minute, 5 minute frequency. Then and you're not trading, let's say, a few accounts, or just you yourself and few of your friends and family. You don't have like an elaborate setup in which you're trading thousands or 2,000s of accounts. I think Python would do a absolutely fine job, and I'm happy to have anybody else chime in to that on that if you have thoughts.
Okay, I'll basically add when oil went negative and when Pfizer came out with its first announcement concerning the vaccine, things just didn't work. And I think it was because of the latency issue at that particular point, even though the trade wasn't necessarily required to be a nanosecond trade, but things just didn't quite work. But if the latency was better, I think it would have worked. But anyway, that's just a small take on things. The other, shall I go on to the next point, or are we
yeah, no, sure, please.
Okay, the next point was basically to do with that was a few tools that we mentioned, so like Python, MATLAB, R, etc. The same perhaps with you and your colleagues sharing your thoughts on the data. So basically, okay, there is Yahoo, Python data, that's fine, but what are some of the better libraries that you would suggest? Once again, this is pre-execution or for executing on once you've used it for your algos, etc.
So I'll give this answer in two halves. I know because some of the audience is from trade Indian markets, and I know you're probably looking at some of the international markets. Yahoo Finance is a simpler way of getting EOD and historical data. There are few websites. There's one called EOD Historical Data, just a plain simple name. They have an API which provides you with a lot of data for free. I have never gone into the deeper depths of it to understand how correct it is, or if they are missing some pockets of data. But they do have a full service wherein they not only provide you with some free APIs, but they also have a pricing model as well to get you the data. So, and I'm sure there are quite a few of those for intraday data. For end of the day.
But what do you and your colleagues actually use to actually trade on? So that sort of approach might be okay for let me test this, or let me back test this, even though that's a bit of a risk. But when it comes to actually, okay, I'm now going to trade on this, I'm quite confident with this. It doesn't sound like the data that you would put money on, correct?
No, this is professional grade data, and there's another one called Alpha Vantage. They also have good APIs. I've personally fetched from that for my let's say SPY or SPX QQQ trades. And for the rest of the audience who's actually trading Indian markets, there are quite a few data vendors I know in Indian markets, GDFL and True Data being the prominent ones, which are exchange authorized as well, which provide good stable data. And for the US one, EOD Historical Data, Alpha Vantage. I'm forgetting there's another name, which is a new startup which I recently came across, who's trying to solve this data problem as well, who looked promising, but I've not tested them out. So I'm sorry, I'm not sure if anybody else has an example for him, which is not from Indian markets. But yeah, that's the couple of examples I would have. All right. We'll just
okay. When it comes to the execution, the last part of it was to do with the execution. So the first part was the tools, second part was the data. Once again, this is simply sharing your insights and your colleagues, just in case there's anything new that one discovers, etc. So when it comes to the execution, excluding DMA, what are you guys using for the actual execution? Which brokers, which systems, etc. Excluding direct market access, obviously.
Yeah, because direct access DMA is not really possible for a lot of the smaller sizes, right? So depending on what they are trading, interactive brokers concentration being a couple of good TradeStation actually have their own coding language, easy language as well. You can code your algos and automate some of your stuff. I know people use that a lot. In option space, I've heard of people using Think or Swim a bit. I know E-Trade as well, but in my opinion, interactive brokers and TradeStation which is kind of used a lot more than some of the other ones.
How about some interesting libraries? Do you have some? Are there some interesting code library out there that you would recommend, or anything like that, or perhaps your colleagues? Or if not at the tip of your tongue, perhaps you can tweet them later.
Sure. So I think a few days back I did tweet something on the lines of the fact that I don't use predefined libraries. Wherever possible, we have used our own own code. So what do you think? If you think about all these libraries, they are just a bunch of codes packaged into a library. What we like to do for our execution is break apart or dig deeper into it. So for example, for Zerodha, which is one of the prominent Indian brokers, we don't use their library such as in we don't use the pre-packaged functions they give. They give their API access and endpoints, and we looked into their functions and kind of build our own code to do the same work that they were doing, so that we are not dependent on.
I don't necessarily mean a black box type library. I mean a library where you can see the code and then you can actually change it yourself. So it's like a halfway house where okay, you're not going to rely on it yourself, but okay, it's already laid out for me. Now let me change this and that to give me the desired outcome. But it was fairly close to where I wanted to go in at the very beginning, at the outset.
Right. So like I said, for me, we looked at the broker's API library itself and then kind of split that apart. For backtesting, I created everything myself from the scratch. I didn't even look at some of the prominent ones like PyTrader, Backtrader, VectorBT. There are a bunch of them. I didn't look at any of them, but these are some of the good examples for the backtesting one. For execution, like I said, we focus more on the brokers libraries and just kind of split that apart. We haven't had a chance to look at some of the other executions which might be publicly available. That's a good point. Maybe I should research on that.
Okay, I'll look out for your tweets. If any libraries are out there, perhaps you tweet them, and I'll check your tweets at a later time. That's me done. Thank you so much once again for arranging the discussion. But before I leave and you hand over to someone else, you had a professor speak earlier, briefly.
Yes. Yeah, she was Linda Kreitzman. She was from my alma mater, UC Berkeley, MFT program. She's not a professor, she's a programmer.
Oh, I see. Okay. Sorry. Perhaps either a bit later or whenever.
Can I comment on this?
Perhaps a bit later or another, or a bit later or another time. She can just give us an insight into on blockchain. What are some of the interesting developments? They don't necessarily have to be the projects that are being incubated, as she discussed, but generally in the field, in the space. What in blockchain is actually out there now that is cutting edge that might help us toward the things that we've been discussing, whether it's being the questions or related to the general topic today.
Yeah, I'm sure she's very accessible actually. So after this space ends, the recording will be on my timeline. So if you'll be able to see her speaking and maybe able to tap to her profile. Else you can DM me. I'll kind of introduce you to her. She'll be happy to help you out.
Oh, I didn't realize she'd left. Okay, thank you so much.
No problem.
Oh, hi. This is Steve Maravelius.
Just can we go in order? Can you just please wait, all of you, whomsoever is waiting for the line? Just give me a quick minute. So I know we've been running this for good hour for 20 minutes. I'd just like to say we'll probably accept a couple of more requests and probably end this in next 30 minutes. So just please keep that in mind, given, this was very impromptu and then it gets starts taking a toll on the speakers. So we'll have, I'll probably say the order in which people join. So I know Kumar Sukhni is the first one, and then Jersey Shore Solutions, and then Minta Trainee are the three next questions. If you can have, I see I have been deserted by my panelists. I am the only one, and Vivek are the only ones here. So I hope I can probably provide some quick thoughts and responses to everybody. And then we'll see if we have time, we'll take more speakers on. So Kumar Sukhni, you're next.
Yeah, hello. I have a question, but before that, I will give one comment on the question which Sugar Market News asked. The lowest latency will be given by the language which you know the most. The language which you don't know will give you the highest latency because you will not know how to optimize it. And Ankit, my question is about the discussion which we had about how to reduce the slippage. I tried 4 to 5 versions till now, but I'm still getting a negative slippage. Like when I'm getting a positive slippage, it's like less, sometimes 1 or 2 points. But if when I'm getting a negative slippage, it's like 4 to 5 points. And at the end of the day, it's always I will end up in getting a negative slippage. So, do you have any thoughts about how to work around it? Because there's no resources available.
Right. So actually, you bring a very interesting point. Because yesterday, actually, he's the Algo Temple handle. He's here as well. He and I had a very long discussion on this very topic, and I'll kind of try and repeat what I spoke to him about. You might not like the answer, but that's I would rather speak the truth rather than giving you a comforting solution. So let's first think about why would slippage happen, and what's the root cause of it, right? So let's say you have a signal, you have a trend signal. This is the easiest one to understand. So what I mean by that is you saying at 11 o'clock you get a signal that the market is going up and you want to go long, right? Now, if there's any strength to your signal, if the signal is good, you would expect the market to be running in that direction, right? So no matter what you try, you will incur a slippage. The backtesting close price that you see on your candle is not how the live market behaves or trades, right? So it's like that, the catch-22 situation. On one side, you want to minimize your slippage, but on the other hand, you want a very strong signal. You want to trade the strong signals that are expected to make you money, right? So it's counterintuitive that we are trying to minimize slippage, but we don't want a soft signal, because if it's a weak signal, that's when you will be able to fill it at a better price. So let's say the candle closing price was 100 rupees or $100, whatever it is, and you are able to buy it at 99 because the signal is probably not that strong. So that's the first
Yeah, but
caveat.
that I can understand. But mine is an option selling system.
Doesn't matter. It's still the same thought, right? When you're selling whatever thing you're selling, you are expecting it to be going in the direction you are trading it.
No, it's a non-directional. I'm selling a triangle.
How is it non-directional? Even if you have two legs, you want both of them to go down, right? If you short two of
Yeah.
them and both of them go up, you'll still lose money, isn't it? So how?
Yeah, but when we are each leg is compensating each other. If one goes up, other will go down.
Right. So see, when you're creating a straddle, then you expect one. When actually in that case, you should not be worrying too much. You should not be actually getting a negative slippage or too much worse of a slippage on both the legs combined. Because if the market is jumping around, then one leg will go in your favor and the other one will go away from you. So even if you trade market on both of them, you are expecting to net off your slippage on one versus another, right? So in those systems, it's actually easier to get at the price, assuming it's not, it's not like a wall jump or crush event, and It's usually like a directional move, which is making you slip, right? The point I was trying to make earlier was that slippage is a bigger concern in directional systems. In that kind of a system, you see, whenever, even if you're shorting both of them, wouldn't you want both of them to go down, right? That's what you would want. Ideally, you're probably shorting it when the wall is crushing and you want to get on it for times, right? But in the absence of such a signal, if you're naively entering a two-legged trade, it should compensate each other. So I would expect it not to be that concerning in that situation as compared to a directional trade. I would be more concerned about my slippages in a directional trade. That's the first point. Uh, the second thing is, now think about how the backtesting data is available and how the live market trades. Your backtesting is just a snapshot, right? It's a 1 minute data. It has one price for open, high, low, and close. But anybody who's traded and observed the markets, you would know there are ticks. Like within 1 second, it might change twice, and sometimes it may not change in 5-10 seconds as well. And this is general markets. So if you are looking at index options and index futures, they probably have multiple ticks within 1 second. It's not even one tick per second, right? So how do you decide? How does your execution decide that the candle has closed? It has to wait for that nanosecond timestamp after 11 o'clock for the candle to close. That's the earliest you can trade is once you know that time has elapsed beyond 11. Whereas when a historical data candle is created, that's not the case. They take everything for given and you just resample. So how do you mitigate that is by assuming much more strong slippages in your backtest to make it realistic to live examples, right? So oftentimes people who are most concerned about the slippages are the ones who have taken very small assumptions about slippage in their backtest. And that's when they come in live markets and these small frictions add up to the delta, the gaps, they are bothered about it. And if actually that's the case, then probably it's worth looking into some of your methods of generating signals as well. But that's what I do when I backtest. I have enough sufficient buffer. I would rather have a large cost on my backtest and then try to beat that in live market rather than have a small cost in my backtest, come up with a very beautiful looking curve and say, oh, in my live market I'm not able to achieve that, right? Because I would rather spend time on research in getting something which can suffice even after a large cost, and so that my execution, I have more leeway in fucking up on the execution, so to say, right? So that's these are some of the philosophical, for lack of a better word, philosophical questions on slippages, right? Now the question comes to how do we minimize it or how do we improvise on that? And unfortunately, the only way is, you have to, there is always a trade-off. The trade-off is you trade the market, which is urgency, or you wait and you get a worse fill, right? So if you wait, in some instances, you might get a better fill. In some instances, you may get a worse fill. And you have to do a lot more analysis to think, to come up with the answer. If I have to wait, how long should I wait for? If I have to start with a limit order, where should it start? Or what? I mean, it's not a simple answer, and it's a lot of research that goes behind it. Like me and my partner, actually, I've never introduced him. Let me do that. Ibrahim, let me have you on the stage, man. Why don't you speak up? I don't know if he will. All right, I'll invite him to speak. Let's see if he wants to speak up. All right. So what we here is, Ibrahim, can you hear us? Yeah.
Yes. Hi.
You want to add to that, man? So Ibrahim, by the way, is probably the first time I'm talking about him. He's the one who's part of Decibel as the CTO. He runs a lot of this stuff for us. He and I bounce off these ideas. So Ibrahim, without let me put it this way: without disclosing anything proprietary that we have discussed, a general idea might be helpful for the people.
No, I think you kind of summed up what you were trying to say with respect to, containing slippages in that way. I think, as you said, this there's a lot more analysis which goes into it, and you probably might need big data to if you're really trying to model it, I would say, to some extent. And also especially the kind of data, like if you're using Zerodha data feed, it could also be that sometimes it's more than a tick, things like that. So I think there's a lot more analysis which has to go in to kind of model this, as far as at least from whatever understanding we have had when it comes to handling slippages. And it can also be erratic, like we do have these erratic spikes once in a while, and that can also eat up quite a bit of your slippages too. But then I'm sure there are quite a few research articles out there which I think especially focuses on the US market. But I think it kind of also gives you a lot of ideas, or like a lot of starting points, how to try to see to model these things, I would say. But I think you covered kind of the basic idea of how to look into it for sure.
Cool. Thanks. So as I was saying, the analysis have to be a lot deeper than that. One of the things that I did suggest, Algo Temple, as he calls himself on social media, is that look at the alpha decay of your strategy. So what do I mean by that? So let's say your trade signal comes at 11 o'clock. Now you should see, and again, this is from a directional, non-directional, doesn't matter. Think about the concept first, and then you can apply it to any kind of system. So think about how soon, so, kind of try and plot this. On your x-axis, plot T0, T1, T2, T3, which is, let's say every 1 minute interval, discrete steps, right? T plus 1, T plus 2, T plus 3, T plus 4. And on our y-axis, plot the return of the trade that you've taken after it has come up, right? And this cannot be for one trade. It has to be aggregated across 100 trades. So what I mean by that, on y-axis, you have an average PNL of your trade 1 minute after the signal arrived. And right, you kind of spread it out in time from T plus 1 to T plus 20. And what you would expect to see is this inverted or exponential curve, like a concave curve, which will have its highest point when the signal arrives. Expectedly, that's how you want it to be. And then it decays, right? It will decay and it will never go to zero. It will probably go to exponential infinity if it has some mathematical properties to it. So what it can tell you is this kind of analysis. It can tell you how fast your alpha decays once your signal comes in, right? Or what's the half-life of your alpha. And that can also tell you how long can you wait before you want to get in. So if you do this analysis, so there's, people think about slippages is just like asking 2-3 things and, creating a 2-3 rules and just slippages will minimize. No, there's a lot of analysis that goes behind it before you can actually try to get better fills, right? So that can help you with the question that, if my alpha quickly falls off the cliff after it comes in, and that's, one of the questions that the previous speaker, Sugar Market, asked, the latency question, right? If your alpha is sensitive to you getting to the market, you don't care about slippages then. You just go and trade. You lift the offers, you lift the ask, whatever you want to do, right? You paid or given, as the terms are. You do that. But let's say if you have some wiggle room, if your alpha decays slowly in the first few minutes, then you have more room to wait. But you have to do this kind of analysis to think about these things. And otherwise, and in the end, the last point I would want to say, slippage is kind of a necessary evil. You better understand that and accept that, and live with it, and just use more complex and more harsh assumptions rather than soft assumptions on your backtest. Sorry, it probably was a long rant. I'm not sure if it helped, but happy to have a follow-up question if at all, Kumar. If not, I'll probably move. I know I want to end this in a few minutes, so I just want to give chance to a couple of other people who are on the call. So, Jersey Shore Solutions, do you want to speak next?
Yes, how are you? Steve here. Very insightful and informative. Nice to hear from you and your partner. My biggest problem, and had to see, I passed the Series 7 here in the US 20 years ago, and I've been trading, but I feel like nobody can build what I want, and there's always data issues as far as, like, I'm not an actual programmer myself, but going from MT4 to MT5 to NinjaTrader 7 to 8, and now thinking that TradingView was going to kind of solve all my problems. I've had some issues with data and what I'm trying to build out myself. So I don't know what insight. I know you said Python, which is something that I believe that I may look into, but ultimately what I'm trying to do is just build a, if you want to call it, a super confluence of the different types of traders who are out there, from moving averages to candlestick patterns to Fibonacci extensions and retracements, breakout, divergences, and it seems like every time I talk to a coder, whether it's PineScript or Python, they always seem like there is a hurdle, and whatever data set they're running, they say that it kind of slows down the results, and we can never really get the achieved results, or at least just the back testing that I'm looking for. So I appreciate your help, and find the discussion very insightful and informative.
So let me try and understand your question. So you're saying you've tried out the MT4s, 5s, Ninja Traders, trading views, and it seems they leave some gap, and you're wondering if something like a Python or a more advanced language will solve it. Is that a fair assessment?
Yeah, pretty much. I mean, I had actually upgraded to a I don't know, 2800 special chip laptop when I was running NinjaTrader, and to be able to perform the back testing. And then I said, well, let me go to not Thinkorswim, but using PineScript language with TradingView, so it would run on their platform and not on my laptop, as far as the back testing and the analysis and optimization. And it seems like I'm not really they're not able to fulfill what I need. So yeah, that's basically my
Yeah,
question. Do you
I get it.
think that Python would,
Yeah,
would basically take
yeah.
care of it?
So let me try and answer that, because I've gone through that cycle. Uh, so some of the benefits of these pre-canned packages like NinjaTrader or Easy Language for TradeStation or MT4 or Ami Broker in India, uh, is that they are there are product development teams behind it who have optimized the backtesting process. Their whole value addition is that you write the code in their language, and they're going to spit out a backtest in 5 minutes, 2 minutes, whatever the time might be, right? um, and what it does is, it kind of, because they have to optimize for speed, they have to reduce the degree of freedom in the system, right? So what do I mean by degree of freedom, for those who may not understand this? Is degree of freedom is how many choices you can allow a system to take. So if you're building a wide system with and this is a very simplistic uh, explanation, please don't hound me for the technicalities of it, but that's what degrees of freedom mean. So when somebody is creating a canned package, they have to kind of put an outer boundary on how many degrees of freedoms their platform can allow, so that they can deliver an optimized or fast backtest, right? So what that means is, while you'll be able to do a test out a lot of ideas, you'll not be able to test out everything that's out there, right? So that's the trade-off of using these. Now, on the other hand, open-end coding language like Python or C++ or whatever you want to pick it up is unbounded. You can create however complex rule set you want and can test it out. But then the caveat there is, since we are not super programmers, we don't have a team behind us, it's just one of us, and we are writing this code maybe in our basement, in our living room, or whatever it is, we can't optimize it as much as somebody who's running it commercially can. So what happens is, your self-written code can probably handle a more complex backtest, but it may not be as quick. And actually, that's what happens with me. Some of my backtests sometimes runs for 2-3 hours at stretch because I've written so many conditions and loops and blah 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 that it just doesn't go faster. And rather than trying to make it faster, I think about, okay, I'll do this on a small sample, like 1 month and 2 weeks of data, whatever it is. And once I'm satisfied that it is running fine, then I will leave it for the night and just go to sleep, because I, I would rather research new ideas than upgrade myself as a super coder, right? So there's always these trade-off in the two choices. And, unfortunately, there's never one answer that can fit all. It depends what you want to achieve and what problems you're facing. So that's just my kind of 2 cents on that. Not sure if it answered your question.
Thank you. No, I definitely appreciate it. And I think that's just, I'll just have to keep searching and finding the right coder or programmer, and then also finding the right system. And because I'm trying to build something that is going to be a little bit self-learning, but also takes into account, a lot of the volume flow, the obviously pivot points, moving averages, and all that stuff, not just one indicator, but something that will have obviously low drawdowns with a high profit factor.
Right. Great. Thank you. All right. Probably
Thank
the
you.
last speaker of the night, evening, Mentat 20. Sorry, man, to have you waiting.
Hey, no problem. Thanks a lot for the session. And yeah, first of all, I'm watching Manchester United in parallel. Bloody disappointing it is. So I at least asked the question here, so it's okay. So hey, so it's a very generic question. It's a product level question. So I've been researching on the Forex market, the currencies and commodities, and all that. So I know the whole world is working on options, and pretty much I see options trading on Twitter most of the time. So do you? The Forex market, the problem is like with the pip size, the spread is quite big, and is it actually worth spending more time on it? Because I find it extremely challenging to actually build a good algo, because I'm able to build an algo when I backtest it, like it produces 6 months of profit and then 6 months of loss. So or do you think like options is the way to go, and I should probably like switch and move on?
So I started my career as an FX trader, and I'm assuming, are you in India?
No, I'm in Singapore actually.
Oh, you're outside. Okay. So, but let me answer it for the audience, because I know a lot of traders are in India and might be wondering that. Okay. So the FX market is a completely different beast when compared to equities and options market, right? And the reason is that, anybody who's wanting to trade FX should think and probably research on the players in the FX market and what their motivations are. So the biggest bulldog in the FX market is always the central bank, right? So you can create whatsoever kind of system or whatever method, and a central bank can come in and change it in given day, right? And one of the examples of this is the Euro CHF peg. Way back in 2009, was it? I think it was 2009 or 8, somewhere around that time. Euro used to be pegged against Swiss franc for 1.2, right? And owing to market dynamics, they one day announced we are removing the peg, and it dropped by 20%, right? Because it kind of went to parity. So, so the players in FX are very, very different. And not only that, it's an entirely OTC market. Like, there's no centralized exchange. There's a lot of bilateral dealing that takes place between the banks. I was a bank FX dealer. So we used to trade bilaterally with other banks. And think of these as the block deals, but like in exchange, when a block deal happens, even after it happens, it at least gets published in a public ledger, or people get to know about it. Whereas in FX, nobody gets to know it. So the information discovery is much more opaque in FX markets. So there are many challenges of trading FX. Now, to your point about the pip, so pip is 1 by 10,000 or fourth decimal point of an FX price, right? So let's say Euro USD, now it has broken below parity. But let's talk about cable. Cable is pound. So pound USD is right now 1.20. So it's 1.2018. That's the price that FX trades off. So this eighth, or the last decimal, or the fourth decimal, is the minimum ticket which is tradable in the market, right? So it's highly leveraged because FX otherwise they don't have high volatility. Unlike the past few months in which we have seen dollar strengthening like crazy. But if you look at the history of FX markets, they're not as volatile, right? So the only way for a retailer outsider to make money is to have a highly leveraged take on that, because people trade. I know, when I used to trade FX as a retailer, we used to trade for 20, 30, 50 pips, 50 pips in a day, and that would be a good day, right? So essentially it moves that small, and it's driven by a lot of factors. So it's much harder to find alpha. And then FX has been around for so long, and there are so many funds who are trading. So think about how big funds trade FX. And I mean big funds as in prop funds, not the funds which are doing it for FX balancing or their treasury balancing, right? They are international organizations who are rebalancing for nullifying their exposure to foreign currencies, right? So prop funds, a lot of it, at least it used to be 20 years ago, cross exchange arbitrage, latency arbitrage. So the price you get, because it's an OTC market, you have servers in New York, London, Dubai, Singapore, Hong Kong, all this around the globe, Tokyo, right? And they're all quoting different FX prices. So you see two different prices at two different locations, and then you have this latency between these two, and then your latency of your infrastructure to kind of take it up, right? So there's an arbitrage which may be occurring, but can you take that up? That's how the FX market makers, FX traders used to trade. I've worked as an FX market maker as well, both electronically and voice trading. And honestly, market makers are condemned for saying, oh, market makers hit our stop losses and they're taking the market here and there. As a market maker, we didn't know shit where the market was going. All we cared about was managing our inventory and maybe at times skewing our prices to make sure if we get, market hits us. Let's say a lot of people come and sell to us. Then I'm suddenly more long than I want to be. And I'm not getting enough sell flow, the other side flow, or people not buying from me. So I want to make my buying price attractive so that people come and buy from me, right? So that used to be our concern. We were not concerned about, let's say, when I was in India, we used to make markets in Indian rupees. Market opened at, let's say, 45 rupees and 10 paisa. And I don't care if it's going to end at 45.20. I cared about next 2 minutes, 5 minutes. Is it going to jump on me and I'm going to hit a big loss, or can I just hold on to my inventory and passively get out of it? Those that market makers think about. So you as an external trader who's completely disconnected from a lot of this world, I would say it's much harder. I would not say it's impossible. There are some effects. Like one of the interesting things to look at it in an FX is time foundation. So FX is a 24 market, just like cryptos are, right? So you have these different international markets opening up, right? You have London Open, you have Frankfurt Open, and then you have New York Open. And then several currencies have very peculiar behavior around these opening hours, right? That's all I would say on FX, right? So it's not that it cannot be traded, but it's just a very different beast to trade in.
True.
So yeah,
thanks a lot, man.
Yeah. All right. I know we've it's been close to 2 hours I've been speaking, and I see Prashant back. I don't know if any of I'm just gonna invite them. Prashant, Pranav, Vivek, maybe Ryan, if you have any closing thoughts. Otherwise, we'll just end the space fairly quickly. All right. I think that's it then. Thanks everybody for joining in. It was a fun impromptu space. And yeah, see you all guys around. Thank you. Thank you, everybody.
Thanks, Ankit.